Spark Infrastructure provides exposure to approximately 17 billion of electricity network assets in Australia, situated across 3 states, Victoria, South Australia and New South Wales. Our assets supply 5.5 million customers with their power and employ 5,100 people. You can see on slide 2 now showing on the screen the split of our assets. So Transgrid, which is the New South Wales high voltage electricity system, of which we own 15%, has a regulated asset base of nearly $6.8 billion. Our 2 distribution networks, Victoria Power Networks, of which we own 49%, has a regulated asset base of $6 billion, and SA Power Networks, located in South Australia and encompassing the entire South Australian electricity network, has a regulated asset base of $4.1 billion. Turning to some financial highlights. Looking at a half-year performance, our adjusted proportional EBITDA is up 7.6% to $420 million. Our standalone operating cash flows increased nearly 7% to $130 million. On a proportional regulated asset base plus contracted asset base, our RAB and CAB increased 4.1% to just under $6 billion. We have very strong investment grade credit ratings with leverage on a debt to RAB and CAB basis of 74%, with a weighted average debt maturity of greater than 5 years. All our assets are rated investment grade, with both SAPN and VPN having ratings in the A category and Transgrid in the B category. Our networks are the leaders in efficiency, reliability and safety. The Australian Energy Regulator undertakes reviews on an annual basis to benchmark the distribution businesses against 14 other distribution businesses in Australia, and Transgrid against 5 other transmission networks in Australia. The 3 of our networks are ranked 1 or 2, depending on the basis upon which you look at those measures. We would maintain that as a result of these very strong metrics, if you're going to invest in regulated assets in Australia, you want to be invested in the best networks, the most efficient networks, and the most reliable networks. As Nathan mentioned at the start, right now we're trading on a very strong cash yield, roughly 7.2%. We've guided to a 16-cent distribution for the full year, and the board maintains this guidance. That was DPS growth from 17 to 18 of 4.9%. As a result of the timing of our regulatory reviews, we have high cash flow visibility through to 2020. Transgrid right now has a 5-year regulated reset in place, which will take us through to 2023. South Australian Power Networks has revenue certainty through to June 2020, and Victoria Power Networks through to 1 January 2021. The regulatory regime is inflation linked, so as a consequence, higher inflation levels are actually supportive of value and distributions. The regime allows for a large amount of pass-through of increases in interest rates. So our debt rates are effectively passed through to the revenue-related WACC. So when debt rates go up, our revenues also increase to a higher level. And finally, in terms of growth, the businesses have a natural amount of growth, principally driven through higher population growth and therefore new connections. If you think about Victoria, which has the highest levels of population growth in the country, our Victorian Power Networks sit across the high growth corridors within that state. South Australia growth is modest, but there is growth. And Transgrid has very strong growth as a consequence of the change in the broader energy system, necessitating greater levels of connectivity between states to build reliability and redundancy within the transmission regime. The energy regulators have recently released a report called the Integrated System Plan, which requires Transgrid in time to spend $2.7 billion on developing further interconnection within New South Wales, principally to support Snowy Hydro, the expansion of Snowy Hydro, to support connection between South Australia and New South Wales, and enhanced connection between Queensland and New South Wales. Into the future, of course, electric vehicles will present huge challenges as they're rolled out, and will further require grid reinforcement and likely significant CapEx spend.